Okay, another foundation to the equity open and mastering it. Midnight opening price and 8:30 a.m. opening price. Okay, so we're going to be utilizing two opening prices for the equity open, and it's that midnight and 8:30 a.m. opening price. Okay, in a bearish scenario, how would we look at the opening prices? The highest probability shorts are when we are above both opening prices, okay? If the market in London has already gone above the opening price at midnight into a key level with stops being ran out, then we use the 8:30 a.m. opening price as our reference point to sell above or very close to in the equity open. Okay, so if we've done our analysis and we've market profiled and we can see that London has probably set the stage for high of the day and we're bearish, right? And midnight open is really high above our PD arrays, way above premium that's required to sell short in New York equity open. So we're not going to be referencing midnight because we're not expecting it to get all the way back up there, right? What do we reference then? 8:30 a.m. We're going to be using 8:30 a.m. then on its own. Okay, so here's an example of the highest probability shorts, right? And here's midnight, okay? Midnight open, right? We're trading above it. We trade into a key level, we run out stops prior to 9 to 10:30 a.m. Market trades lower, inverse fair value gap, IFVG. We're above both opening prices here, making this extremely high probability shorts because we're in an extremely deep premium when we're above both the opening prices, okay? I've also included this IFVG because this is still valid. Why? It's above the midnight open and it's very close to the 8:30 a.m. open. So it's relatively in a very strong premium as well. You can see we nicely trade back up into this little IFVG there and then sell off aggressively, right? The biggest moves are going to happen when you short above both opening prices, right? Okay, here's an example of when we wouldn't be expecting, right, price to trade all the way back up to the midnight open. So midnight open, London session, sets the high of the day here, runs out stops, okay, goes above the midnight open. That's extremely important. London must go above the opening price. Then we create a dealing range here from this high to this low, premium high to discount low. Okay, now as we're approaching 8:30 a.m., right, we've profiled the market. It's not extremely overextended. We have a high, a low broken, the high that broke the low, turtle soup level. We turtle soup it, okay? And now we're using the 8:30 a.m. as a reference point to sell above or very close to the opening price, right? So we trade above the 8:30 a.m. opening price, take out the stops, 9:30 a.m. distribution, close below. This bullish FVG becomes an IFVG above the 8:30 a.m. open, and you see a nice aggressive move on the downside. In a bullish scenario, okay, the highest probability longs are going to be when we are below both opening prices, midnight and 8:30. If the market in London has already gone below the midnight opening price into a key level with sell stops being run out, then we use the 8:30 a.m. opening price as our reference to buy below or very close to. Okay, so here's an example of an extremely high probability long. Market opens here, trades below all these stops. London sets, or actually London launch hour sets the low of the day here. We run out stops, 3 drives, close above the collection of down close candles here, discount, premium, okay? Opening price at midnight, opening price at 8:30 a.m., highest probability longs are here. We expand, trade back down with a deep retracement. Where? Hits the opening price. That is not random. Notice the 8:30 a.m. tag there and the midnight open tag there. You always want to have these opening prices mapped when you're trading the equity open, okay? Because look at the reactions you get from here, okay? So high probability longs, very deep in discount. Okay, here is an example, right, of the market trading with the 8:30 a.m. open on its own, right? So if we look at this here, sorry, this is covering it, but there's a short-term low here. We traded below it during the Asian session. Then we expand during London, okay? We have a discount low, premium high. The market then starts to accumulate. So we have chop, right? Why does it chop here, right? Because of the expansion here. Then it chops, trades into discount, okay? We have relative equal lows below us, okay? We're bullish. When there's relative equal lows below us and we're bullish, what do? We wait for relative equal lows to get taken, and we are below the opening price at 8:30 a.m. within our equity open kill zone. So if we can't get down below here, the midnight open, our reference point for discount longs is going to be the 8:30 a.m. open, and we would use some kind of lower time frame PD array here that forms after running out the relative equal lows. Again, this is really crucial to determining the manipulation or distribution of that 9:30 a.m. candle and how we can catch it, right? When it's either distribution or manipulation, we'll be able to catch both.